Hello students, a warm welcome to all of them. I hope you all are doing good and fine. In our today's session, we will continue the chapter number 8, Capital Allowance. In our previous session, we had completed these 4 topics: definition of plant and machinery, compute writing down allowances, first year allowances and annual investment allowance, capital allowance for cars, compute balancing allowances and balancing charge. In our today's session, we will do these 3 topics: compute structures and building allowances, recognize the treatment of short life assets, recognize the treatment of assets included in the special rate pool. So students, we have already seen capital allowances provided to avail tax relief for capital expenditure on qualifying assets. Depreciation charge in accounts is not allowable in computing tax adjusted trading profit, hence we calculate capital allowance, and capital allowance is reduced from the accounting profit to arrive to our tax adjusted trading profit. Depreciation is disallowed, so it will be added back to the accounting profit, and capital allowances are available for qualifying assets, that is plant and machinery used in trade or profession. Capital allowances are available for both sole trader and companies. For companies, we will be covering the capital allowance under the chapter number 13. In tax examination, unincorporated business using cash basis, for them capital allowance is not available. Now students, coming to the qualifying expenditure, capital allowance are given on the original cost of the asset, and if any subsequent qualifying expenditure are done, like capital improvement or capital expenditure are done, this capital expenditure will also qualify for capital allowances. And what are the reliefs available for capital allowances? Allowable deduction in calculating tax adjusted trading profit. And students, one important point: capital allowances is calculated for period of accounts. I hope this is clear. Now, as we have seen the definition of plant and machinery is commonly understood term. When we came to the case of plant, we had seen key principles, how we determine whether the asset is plant and machinery based on the asset's performance for the business. If the asset performance is active function, plant and machinery; passive function, then it will not be classified as plant and machinery. Active function means which with the help of the machine or the asset we are able to run the business. If that machine is not available, we will not be able to carry our business. So it is actively involved. The opposite of active, it is not actively involved, is passive function. And we have seen assets which are deemed to be plant irrespective of the special rules applying. Cost of alteration to building needed for installation of plant, expenditure or acquiring computer softwares. And assets deemed not to be plant are land, building and structures. We have a separate allowance known as structure and building allowances. And students, these are the few examples of plant and machinery which are most tested in your examination: computer and software, machinery, cars and lorries, office furniture, movable partitions, air conditioning, alteration of buildings needed to install plant and machinery. I hope this is clear. And then student, we had seen the capital allowance format. First, we need to see the asset, the capital asset or the qualifying expenditure falls in which pool, whether main pool, special rate pool, short life asset or private use asset. Then we will calculate the capital allowances. The format starts with the tax written down value brought forward and the additions which we are purchasing in the year, in the period of account, qualifying for FIA or AIA, and additions not qualifying for FIA, AIA. Then disposals. After reducing the disposal, we get the balance of the pool, and on the balance we calculate the WDA. After reducing the WDA, we get our tax written down value carry forward, and this column provides the total of the allowances which we can use to adjust our tax adjusted trading profit. Students, we have already seen that the three types of allowances which are available are AIA, FIA and WDA. So students, as we have seen, there are four types of pool. First, we had covered the main pool. Generally, expenditure on plant and machinery becomes part of the pool of the expenditure on which capital allowance are claimed. So, generally, all the items on which capital allowances is calculated, that is, capital allowance is calculated on qualifying expenditure, generally, all the expenditure, qualifying expenditure will be treated under the main or general pool if specific conditions are not satisfied as per the other pools. And we had seen two types of cars which are included under the main pool. Cars with CO2 emission between 1 gram and 50 gram per kilometer, and second-handed cars with zero CO2 emission. And student, we have also seen when an asset is acquired, it increases the value of the pool. If an asset is disposed, it decreases the value of the pool. Then we had seen certain items which are not included in the main pool, that is short life asset, private purpose by the owner of the asset, and items which are included in the special rate pool. And students, new zero CO2 car emissions, new or second cars with CO2 emission in excess of 50 grams. This will be included in the special rate pool. Then we had seen the annual investment allowance. The annual investment allowance is provided so that businesses invest more in plant and machinery to generate more income such that the economy of the country goes up. So this is the reason annual allowance is provided, AIA, annual investment allowances. And we had seen students, the annual investment allowance limit is 1 million pound, and it is for each 12 months period. Each 12 months period of accounts. And we have seen that it is available for all businesses, available on acquisition of plant and machinery in main pool and special pool, and also the other two pools. Not available on cars, especially AIA is not available on cars. And this limit of 1 million is for each 12 months period, and if the period of accounts is varying, it is whether more than 12 or less than 12, we need to adjust the 1 million pound. If the period of account is more than 12 months, the annual investment will increase. If the period of account is less than 12 months, the annual investment allowance will decrease. And we have seen students that the AIA will not be available in the period of accounts when we cease our business. When there is cessation of trade, the AIA will not be available. And if the limit of AIA is exhausted, then the rest balance will qualify for WDA. Will qualify for WDA, students. Will qualify for WDA. And students, the order for using the AIA is first the special rate pool, main pool, short life pool and private use pool. And this limit of 1 million will be provided in the tax rate sheet. Then we had covered the first year allowances. First year allowances is available for new zero emission cars, new zero CO2 emission cars, and it is 100%. And students, when we use the FIA, we can't claim the WDA in the first year. We can't claim the WDA in the first year. FIA is only partially used. The balance of cost goes into the main pool, but is not entitled to any other allowance in that first year. After the first year, for the next year, we can calculate the WDA. And students, the FIA will not be adjusted as per the length of the period of accounts. I hope this is clear. And this we have done, this we have covered. And students, the FIA is also not available during the period of accounts in the cessation of the business. When there is cessation of trade in that accounting period, FIA will not be available, also AIA will not be available, and WDA will also be not available, will not be available. And students, we have seen if second hand car that is zero CO2 emission car is purchased, it will be treated under the main pool. Then we had covered the written down allowances. The written down allowance for the main pool is at the rate of 18%. And how do we calculate the written down allowances? The written down allowances is calculated on the amount after doing these four adjustments. That is, the unrelieved expenditure in the main pool brought forward at the beginning of the period of accounts, that is tax written down value brought forward, plus additions which qualifies for AIA FIA but exceeds the limit. The additions which qualifies for AIA but exceeds above the limit, the amount will fall under the main pool, and after that additions not qualifying for AIA or FIA and disposals, after the disposal we get a value. On this value we will be calculating the WDA. For main pool the rate is 8%. This WDA is same as the depreciation. We had the SLM basis and the other method, written down value method. This is same as the written down value, the WDA. And in the IAS and IFRS the percentage were different, but in the tax rules the percentage are different. I hope this is clear. And WDA is also not available in the cessation of the trade in the period of account in which the business ceases. Then students, we had covered short or long period of accounts. If the period of accounts are short or long, we need to adjust the 1 million pound of AIA and the percentage of WDA, that is 18%. If our period of accounts exceed 18 months, more than 18 months, then we need to prepare two capital allowance computation, first for 12 months and the rest months. Let's take an example of 20. So first 12 months and rest 8 months. But when we adjust this figure to the tax adjusted trading profit, we will add this figure. The figure of capital allowance in 12 months computation and 8 months computation will be added together for the adjustment in the tax adjusted trading profit. I hope this is clear. Then students, we have seen the FIA. There is no long or short period of accounts, no adjustment. Then we had covered length of ownership in the period of accounts. As we have already seen students, the length of period of account matters. The length of ownership of the asset does not matter. Either we purchase at the start of the accounting period or at the end of the accounting period, the WDA will be calculated for the whole length of the period of accounts, that is accounting period. This is the important point students, because depreciation we apportion according to the months availability of the assets, but when coming to the tax rules, the WDA will not be apportioned. I hope this point is clear. The actual length of ownership of assets during the period of account is not relevant. The WDA is available provided the asset is owned on the last day of the period of the account. I hope this is clear. Then we had seen sale of plant and machinery, that is disposal, and disposal happens at lower of two things: sale proceeds and original cost, and this is deducted after the following adjustment have been made. First, we bring down the tax written down value, addition to the pool, additions which does not qualify for FIA or AIA, additions which qualify for AIA, annual investment allowance, but exceeds the limit of 1 million pounds. Then students, we adjust this disposal. After the disposal, we get an amount. On this amount, we calculate the WDA. I hope this is clear. Now, then we have seen the balancing charge. Balancing charge arises when the disposal proceeds is more when compared to value in the pool. The value of the pool is 10,000 pounds, but the disposal proceeds is 12,000. This creates a minus 2,000 balance. This is created because we have exceed the capital allowances. We have calculated more capital allowances when compared to its original cost. We have the pool will become negative because allowances exceeding net cost have been claimed in the past, and this negative amount, students, will reduce the allowance column total. If we have other capital allowance, if the balancing charge is net and we do not have any other allowances, this figure will be added to the tax adjusted trading profit, because this will be an income. And the income needs to be taxed. The BC reduces the capital allowance claim for the period. If there is an overall net BC, it is added to the tax adjusted trading profit. I hope this is clear. Then we have seen the cessation of trade. When a business permanently ceases or discontinues, AIA, WDA and FIA will not be available, and the normal capital allowance computation will not be prepared. Any additions will be made in the final period will be added to the respective pool, will not calculate any AIA, WDA or FIA, deduct any disposal made in the final period, and any sale proceeds which you have received from selling the plant and machinery during your cessation. When you cease your trade, you sell the plant and machinery, the sale proceed which you have received you need to adjust. After doing the adjustment of disposal, either we come across a balancing charge, the negative balance, or balancing allowances, which is the positive balancing charge, negative balance. Either positive balance will be balancing allowances, student. It will be balancing allowance, and this balancing allowance is only available for main and special rate pool when the business is seized, when the business ceases. I hope this is clear. And this 2000 we will the whole amount will be taken to the allowance column. When we cease our trade, the balance of the pool must be 0. I hope this is clear, students. The balance of the pool must be 0. At cessation, if there is still a balance of unrelieved expenditure in the pool, a business can claim relief for the unrelieved balance by the way of balancing allowance. I hope this is clear. Then we had seen, students, for cars, if purchase of 100% new 100% FIA will be available for new purchase of zero CO2 emission car. If second hand car that is of zero CO2 emission is purchased, it will be under the main pool. If the CO2 emission of the car is 1 gram per kilometer and 50 gram per kilometer, between this range it will be treated under the main pool. And students, if the CO2 emission of the car is more than 50 grams per kilometers, it will be under the special rate pool. It will be covered under the special rate pool. Now we will be starting with the 4 new topics in our today's session. Before that, we had a revision of the topics which we have covered in a previous session. So now moving to the assets with private use by the owner of the business. If the asset is used by the owner for his private use, then we will classify that asset under the private use asset pool. If it is used by his employee, then it will not be considered as private use. It must be used by the owner of the business. Where an asset is used by the owner of the business, partly for business and partly for private purpose, only the business portion of the available capital allowance is available as tax deduction. So this statement is common, students. For business purpose you can claim capital allowance. For private use, no capital allowance. Simple. The following rules must be followed when computing the allowances. Now we will be seeing the approach to solve the question relating to private use. Students, one point you need to keep in mind: whether the asset belongs to main pool or special pool. If there is any private use, it will be classified as a separate pool. each asset, either it is under the main pool or special pool, but there is private use of the asset, it will be calculated as a separate pool. For each private use of the asset, each separate pool will be there. I hope this point is clear. If I have a car I use for private purpose and business purpose, for car you will be calculating private use purpose pool. This will go under the private use pool. If I am using some lorry for my private use, then for lorry you will have a separate private use pool. I hope this is clear. For each asset you will be having a separate private pool if you are using that asset for your private use. The following rules must be followed when calculating the capital allowances. The cost of the privately used asset is not brought into the main pool but must be the subject of a separate calculation in its own column, that is private asset pool. The AIA, FIA or WDA on the asset is based on its full cost, same as the main pool. AIA, FIA, how it is available? It will be available to the private use asset also, but only the business use will be available, but only the business portion of any allowance is deductible in computing the taxable trading profit. Only the business portion is deductible in computing the taxable trading profit. Note that if applicable, the business can always choose the expenditure against which the AIA is allocated. It will therefore be most beneficial for the AIA to be allocated against main pool expenditures rather than any private use asset, as only the business portion of an AIA allocated can actually be claimed. So students, we have seen in our previous session that the AIA will be available for each pool, but the order is first is the special rate pool because the WDA calculated is low, that is 6%, then main pool, then short life asset, then private asset. Why students? Because private asset pool, because the business portion only we can allocate, the rest will not be applicable, so our AIA will get wasted. So first we'll allocate to the other pool assets. I hope this is clear. Only business portion allowance is deductible in computing the taxable trading profit, and the most important point is that we will allocate AIA to this pool at last because AIA will be wasted. Only AIA relating to business use is deductible from the tax adjusted trading profit. However, note that in the examination, the assets mostly commonly used for private purposes are cars which are not eligible for AIA. So mostly in cars, the asset which will be given for the private use will be the car, but on car no AIA is available. So no issues in this point. Cars with private use are always treated separately regardless of their CO2 emission. As mentioned by me, if we are using any car or any asset for private use, it will be covered or it will be dealt under a separate pool. Asset used for private use, private pool for each asset. Each asset is used privately, each asset pool will be there. On disposal of the private use asset, a balancing adjustment is computed by comparing sale proceeds with the tax written down value, same as the disposal proceeds. There is a balancing charge if selling proceeds exceed the tax written down value, and a balancing allowance if the selling price is less than the tax written down value. The tax written down value, if the tax written down value is less and the sale proceeds is high, balancing charge. If the tax written down value is high and the sale proceed is low, it will be a balancing allowances. Having computed the balancing adjustment, the amount included in the total allowance column is reduced to the business portion. So students, this is an important point here. See students, when we calculate the private use here, let's take an example of this. Here we have calculated the private use. When we are calculating the WDA, students, you will reduce the whole amount to arrive to your tax written down value carry forward. But when claiming the allowances, only private use part will not be allowed. Only the business portion will be allowed. I hope it is clear. When we are claiming, the private use will be ignored, only the business use will be calculated. The business use will only be taken under the I hope this is clear. We'll be solving a question so that we have a better understanding. Note that these rules only apply if there is a private use by the owner of the business. Private use of an asset by an employee has no effect on the business owner's entitlement to full capital allowance. If employee is using, full capital allowance will be available. Now students, we will revise the rules and then we'll do a question. So private use, if it is done by the owner, then that asset will be dealt under the private asset pool. If there are many assets which are privately used, for each asset we have a different pool. Private asset pool for car, private asset pool for furniture, private asset pool for other assets. And the AIA, FIA and WDA on the asset is based on its full cost, same as the main pool, but only business portion is an allowable deduction in computing the taxable trading profit. And students, we will allocate the AIA to private use asset pools at last, because AIA will be wasted and the allowance will only be calculated for the business use portion. I hope this is clear. Then on disposal, if sale proceeds is high when compared to the tax written down value, balancing charge will arise. If sale proceeds is less and tax written down value is more, balancing allowance will be created. And students, when we calculate the amount of capital allowance in the allowance column, only the business portion will be considered. Only the business portion will be considered. I hope this is clear. Now we'll be doing a question so that we understand the private use part. Private use of the asset. Question: G runs a business and prepares his accounts to 5th April. Okay, 5th April. As already it is as per the tax year, 6th April to 5th April, students. As at 6th April 2023, the tax written down value in main pool was 11,700. The following transactions took place in the year ended 5th April 2024. Purchase planned for 18,500, so AIA will be available. Purchase a car with CO2 emission of 45, main pool, no AIA, no FIA. Sold some machine for 8,500, originally purchased for 18,000, disposal. Purchased a car with CO2 emission of 43 gram per kilometer for 9,000, used 45 for private purpose by G. So this will be dealt under private asset pool, a separate pool. Now students, coming to the format, first FIA or AIA is available, then main pool, special rate pool, private asset pool, short life asset pool, and then allowances. I hope this format is clear. Now students, coming to this is for the year ended 5th April 2024. So the tax written down value brought forward as students, main pool was 11,700. Now additions qualifying for FIA and AIA. So FIA is only available for zero CO2 emission cars. Here no zero CO2 emission cars. Now AIA, plant has been purchased, students. We have purchased the plant, and on cars No AIA is available. So plant and the AIA, that is 18,500 AIA will be available, and this is within the limit, and no need to no need to apportion the 1 million limit as it is for the whole 12 months period. Then students, additions not qualifying for FIA and AIA. Now coming to cars. So students, FIA and AIA, no claim. That is CO2 emission of 45. This will be under the main pool. So car of CO2 emission of 45 will be under the head of main pool, 19,000. And this AIA will be available here. I hope this is clear, students, the format. Now, and additions which does not qualify for the students. Now, car of CO2 emission of 43, but it is private use as mentioned by me. If any asset that is privately used, for each asset we have a separate pool, that is private asset pool. If we have two private use asset, private pool asset for first asset, private use pool for second asset. So the CO2 car will be under the private use asset pool, that is of the amount 9,400. I hope this is clear, student, this point. Now, any disposals? We have any disposals? We have sold machineries. Disposal will be at lower of DP or cost, whichever is low. So cost here is 18,000 and DP is 8,500. So students, the lower is the disposal proceeds. This will be reduced from the main pool as it is an machinery. So 8,500 the pool. This will give rise to the balance of the pool. So this balance of the pool will be 22,200, 0, 9,400, 0. Now we calculate the WDA, students, at 18% because it is main pool. So here it will be 3,996 and this will go to the pool. Special rate pool, no. Now coming to the WDA for private asset pool, as it is a car of emission of 43, so WDA will be at 18% because it is a main pool asset. Why we are showing it private use, students? Because we need to only select the business portion amount as allowances. So we show for each asset which are privately used, we have a separate private pool asset for each of the private asset. So at 18%, this will be, students, 9,400 into 18% will be 1692. This will give rise to tax return down value carry forward. I hope this is clear. This will give rise to 18,204 and this will give rise to 7,704. Till here, no doubts. Now coming to the catch. How the amount, what is the amount that will be eligible for capital allowance? As we have seen here, students, in a format, 45% for private use. So business use will be 55% into 55%. This is the WDA we have claimed 1692. On this, only 55% will be allowable capital allowance. So this will be 931 students, and the total allowances will be students 23,427 because we had a AIA. So I hope by solving this question the private pool is clear. Private pool is available for each asset which are privately used, and the allowances which is allowable is only the business use. But the value, the WDA will be calculated for the whole amount and it will reduce the value by whole amount. But only allowance we can claim for business portion, because we are using for private purpose, the value of the asset will fall down. So we'll take the whole capital, the whole amount. But for the purpose of capital allowance, only the business portion will be claimed. I hope this is clear. We have completed the assets with private use by the owner. Now moving to the next, the special rate pool. The special rate pool. Students, we have seen the main pool, FIA is done, AIA is done. Now special pool will be doing. We have covered the private asset pool also. Then we'll be covering the short life asset pool. I hope this is clear. Now coming to the special rate pool. As the term special means some special assets are belonging to this pool. Now we will be studying what are these special assets or qualifying expenditures. The special rate pool is a pool of qualifying expenditure that operates in the same way as the main pool. Everything is same, students, same as the main pool, except that the WDA is 6% for the 12 months accounting period. 12 months period, that is, if the accounting period of account is more, we need to adjust. Period of account is less, we need to adjust. Same as main pool. But students, when we give our AIA, the first priority will be special pool. Why, students? We can only claim the allowance of 6% per year. But on main pool, we can claim 18%. If we claim AIA first for special rate pool, we can claim more allowances. First, we can claim on special rate pool AIA. Then on main pool, we can claim 18%, such that our tax written down, the taxable profit will be low. So low income tax will be applicable. Qualifying expenditures. Now coming to what are the expenditures or the qualifying expenditure which are included in the special rate pool. We have seen CO2 emissions cars of more than 50 grams per kilometer are included in this. CO2 emission more than 50 gram per kilometer are included in the special rate pool. The special rate pool groups together expenditure incurred on the following types of assets: long life assets, integral features of building or structures, thermal installation of buildings, high emission cars with CO2 emission of more than 50 gram per kilometer. So students, qualifying expenditure covers these four important topics: long life assets, integral features of building or structures, thermal installation of buildings, high emission cars. High emission cars means with CO2 emission of more than 50 gram per kilometer. Now we will be looking to each of this. This we have already covered. Now we'll look what does the term long life asset means. Long life assets. Long life assets are defined as plant and machinery with both a total cost of at least 100,000 pounds for a 12-month period and an expected working life of 25 years or more. So long life asset means, students, long life asset means the total cost should be at least 100,000 pound for 12 months period. That is, if you have purchased 90,000 and you have done any further improvement, capital improvement of 20,000, this will also be considered under the special rate pool. So long life assets are defined as plant and machinery with both, that is, a total cost of at least 100,000 pounds for a 12-month period and an expected working life of 25 years or more. The asset must have working life of 25 years or more, and the total cost must be £100,000 for 12 months period. Where the business spends less than 100,000 per year on long life assets, they are treated as normal addition to either the main or special rate pool depending on the type of expenditures. If the expenditure is less than £100,000, then it will be normally treated under main pool or special rate pool depending on the case. Generally main pool, but special pool includes long life assets or installation, thermal installation, integral features and CO2 emission of cars more than 50 grams. The following can never be classed as long life assets: cars but added to the special rate pool if high emission. Cars will not be classified as long life asset. Plant and machinery situated in a building that is used as a retail shop, showrooms, hotel or offices. So the plant and machinery students which are situated in a building that is used for retail shops, showroom, hotel of offices will not classify as special rate pool. Special rate pool only available on long life asset, and long life assets will not be classified for cars and plant and machinery which are situated in buildings like retail shops, showrooms, hotels or offices, because we do not have a guarantee that we will run the retail shop or the showroom for more than 25 years. So these are the assets which are not included in the long life asset. First one is the car, and building and plant and machinery situated in a building that is used for retail shop, showroom, hotels or offices. We have seen what does the term long life asset means. Now, integral features of a building or structure and thermal installation. Thermal installation means heaters. Integral features of a building or structures include expenditure incurred on electrical, including lighting systems, cold water systems, space or water heating systems, external solar shading, solar panels, powered systems of ventilation, air cooling or air purification, lifts, escalators and moving walkways, thermal installation in all business building except residential buildings in a business property is also included in special rate pool. So these are the example for integral features like the electric system, cool water system, heating system, air cooling, air purification, ventilation systems, thermal installation in commercial building, not residential building. I hope this is clear. Now moving to the high emission cars. Note that where a high emission car is privately used by the owner of the business, the cost is added to a separate column like an private use asset, but it only receives a WDA of 6% before adjusting for business use. Note that where a high emission car is privately used by the owner of the business, the cost is added to a separate column like an private use asset, but it only receives a WDA of 6% before adjusting for the business purpose. The WDA will be available at 6%, and from this 6% amount will be taking the business portion. The AIA in special rate pool. The AIA is available against all expenditure in this pool except cars. Already AIA is not available for cars. No picture for AIA to be claimed for cars. And business can choose the exact expenditure against which the AIA is allocated. It is most beneficial for the AIA to be allocated against expenditure in the following order. First, the special rate pool. An asset in the special rate pool are only eligible for 6% WDA, whereas main pool, plant and machinery are eligible for 18%. This is the reason why we allocate our AIA to the special rate pool. Then main pool, short life asset and private use asset. Private use asset lasts because AI will be wasted, only business portion can be allocated. Now we will take a short revision and then we'll solve a question. So the special rate pool indicates some special assets will be included in this pool if certain conditions are satisfied. The qualifying expenditure are will be studying. The special rate pool is same as the main pool except only the change in WDA. The WDA year is, students, 6% for the 12-month period, but it is 18% for main pool, and this will be adjusted. I hope this is clear. If the period of account is more than 12 months, it will increase. If the period of account is less than, it will decrease. Now coming to the expenditures which qualify for this pool, that is special rate pool. Qualifying expenditure includes long life assets, integral features of building, thermal installation, and cars with high CO2 emission. Now, what does the term long life asset means? Two conditions must be satisfied. The cost for 12-month period must be £100,000. If period of account is more than 12 months, this will be adjusted. And the second case is that the expected working life should be more than 25 years or more. Then, where the business spend less than £100,000, this will be normally treated under main pool or special pool belonging to the asset. What is the type of asset? And the long life assets will not include these assets. That is, car is not a long life asset, and plant and machinery situated in a building that is used as retail shop, showrooms, hotel or offices. So long life asset, we have done two conditions: £100,000 cost in 12 months period, and 25 years or more usage must be expected to be used more than 25 years or 25 years. Integral features include electric system, cold water system, heating systems, ventilation systems, air cooling, air purification, lifts, escalators and moving walkables. Thermal installation in all business buildings except residential building in a property business. If we are doing property business, it will be included. If not, it will not be included. High emission cars, that is CO2 emission more than 50 gram per kilometer, and the AIA for special rate pool it is provided at the first priority because the WDA is 6% and we will be able to claim low capital allowances. So the order of the AIA to be claimed is special rate pool, then main pool, short life asset and private use asset. Now students will do a question so that we have a better understanding of the short or special rate pool. Apple runs a manufacturing business and prepares her accounts to 31st December each year. So it will be 1st Jan 23 to 31st December 24, or 1st Jan 24 to 31st December 23. As at 1st January 2024, so this will be following. The tax written down value in the main pool was £43,000. In the year ended 31st December 2000, Apple incurred the following expenditure. So before year end of accounting period end of 31st December, the following expenditure have been included. Spent 1,008,000 on new air condition system for the factory. Air condition is special pool item for the factory which is expected to last 30 years. So it is a integral feature. Purchased a new computer and related software for 25,000 and 5,000 respectively. This will be under the main pool. Please do remember students, main pool. Spent 115,000 on new packaging machine. Apple also incurred 4,000 on alteration to the factory in order to accommodate the new. This will be under the main pool. Purchased a new car with CO2 emission of 95, that is more than 50 under the special rate pool, 28,000. In addition, he sold machinery for 10,000, originally costing 60,000. Calculate the capital allowance available to Apple for the year ended 31st December 2024, assuming that tax year 23-24 rules applies throughout. Now students, coming to the format: FIA, AIA, main pool, special rate pool, private asset pool, short life asset pool, and then allowances. So this is for the year ended 31st December, students. 31st December 24. So the tax written down value brought forward, students, 43,000 for the main pool. Now we see the additions. Additions qualify for FIA and AIA. The AIA is available to all the pools. Now we'll be seeing spent new air condition special rate pool, but AIA will be available. So air conditioner of and purchase a new computer related software. This will also classify, will be qualifying for AIA. But students, the computer and software related software is 25,000 and 5,000. So it will be total of, students, it will be total of 30,000. This is for main pool, but the AIA will be allocated first to the special rate pool, student. This is the special item. Now students, the AIA limit is, AIA is only of 1 million pounds. So the 8,000, the remaining air conditioning 8,000 and the computer software of 30,000 will be excess, and this excess will be transferred to the respective pool. This under the special rate pool and this under the main pool. I hope this is clear. Of 30,000. And students, we have a new packaging machine also incurred 4,000. So the new packaging machine will also qualify. Packaging machine, that is original cost 115,000 plus the 4,000, students, plus the 4,000, because the assets are deemed to be plant and machinery. Cost incurred for the alteration of the building to fit the asset and computer. See your students, we have already covered this topic. Expenditure on acquiring computer softwares. I hope the and cost of alteration to buildings. So packaging will also qualify. This will be 119. So the packaging machine will be under the main pool. After additions not qualifying for FIA and AIA. So we have first AIA is allocated to this, then no issue, then this we have done, then this we have calculated, then purchase. So this, students, CO2 emission, car of CO2 emission of 95 gram per kilometer. So it will come under the special rate pool. It is of cost of 28,000. She sold machinery for 10,000. So we have a disposal, students. Additions done. Now disposal, lower of DP and cost. Original cost DP was 10,000 and original cost was 60,000 pounds. So lower of this is 10,000 and this is the disposal of machinery. Machinery means main pool, 10,000. Now we will arrive to our balance. So this will be students 182,000 pounds. The special rate pool will be 36,000 pound, and this will be 0, this will be 0, and the allowance will be taking total. Now we will be calculating WDA. As it is for period of account is 12 months, no need for alteration anything. So it will be at 18% and 6%. 18% for main pool, that is 32,760 students. This we can claim whole amount as allowance. Special pool 6%, it will be students 2,160. So the tax written down value will be, tax written down value carry forward will be students 149,240. This will be 33,840 pounds. And the total allowance will be students 1 million plus 32,760, 2,160. This will be 1,34,920 pounds. I hope this is clear. When coming to the special rate pool, first we need to classify the items which belong to special rate pool and main pool. And first AIA should be given to special rate pool, and AIA is not available on car. I hope this topic is also clear, students. This is the total allowance we can claim. Now we will be covering a further small topic, the small pool WDA. So this means, students, that the balance, where the balance immediately before the calculation of WDA, that is after disposal, students will be having a value. On this value we will be calculating the WDA. So before calculating the WDA, writing down allowances on the main pool or special rate pool is less than 1,000 or less than the balance, or less the balance can be claimed as written down allowance and written off in that year. So students, this means that small pool means that after the disposal we have a value of 900. After the disposal we have the value of 900. On this we calculate the WDA. But student, we have a special case, that is if the balance before calculation of WDA is 1,000 or less, the whole amount we can take to the allowance. The whole amount we can take to allowance column. So this will be 0. So this will be 0. Then we need not calculate the WDA. Where the balance immediately before the calculation of WDA on the main or special rate pool is 1,000 or less, the balance can be claimed as WDA and written off in that year. Note that the 1,000 pound limit is for 12 months accounting period. This need to be adjusted. If more accounting period, limit will increase. Less, the limit will decrease. It is therefore applied proportionately for long and short period of accounts. This claim is optional. This, student, is optional. However, the taxpayer will normally want to claim the maximum allowance available and reduce the balance on the pool to nil. So this is an special case. This is an special case that before calculating the WDA, if the value is 1,000 or less, the whole amount can directly be written off and taken to allowances. And this limit of 1,000 is for 12 months accounting period, and this will be increased or decreased as per the period of accounts. I hope this is clear. Now moving to short life assets. So students, short life assets, the assets which have a short life will be treated under the different pool. It will be treated under the different pool, as we have already covered the FIA, AIA, then main pool. Special pool is same as the main pool, only WDA is the difference. Then private use pool. For each asset which is privately used, will have a different pool, that is private use asset pool. Now coming to the last, short life asset pool, as the long life assets will be covered under the special pool. Now coming to short life assets. Short life asset election exists. So it is an election. Election exists to enable business to accelerate capital allowance on certain qualifying expenditure. So short life asset means students, the assets which have a short life such that we can claim capital allowance aggressively, accelerate the capital allowance on the qualifying expenditure. So the expenditure which are included in the short life assets are, for the purpose of the examination, qualifying expenditure is all plant and machinery with the exception of cars is not included, which would normally go in the main pool. So students, the short life asset pool is available for all plant and machinery which normally go in the main pool, where it is the intention to sell or scrap the item within 8 years of the end of the chargeable period of acquisition. So students, the short life asset means the assets are all plant and machinery which would normally go in the main pool, and the intention is to sell the items within 8 years of the end of the chargeable period of acquisition. In the period in which we acquired, in which it becomes chargeable, from that period till 8 years. If the intention it is to sell within 8 years, then we can create a separate pool. If an asset which belongs to main pool, or either it is a plant and machinery and we are expected to sell or scrap the plant and machinery within 8 years, we will show under the separate pool, that is short life asset pool. I hope the qualifying expenditure is clear. The expenditure which qualifies for the short life asset pool, all plant and machinery which would normally be under main pool, but we accept or we have the intention to sell or scrap the asset within 8 years of the end of the chargeable period of acquisition. Now the process for computation, how we will compute the short life asset. It is same students, because it is main pool, follow the main pool procedure. But when coming to short life asset pool, it is the third priority for AIA. If the election is made, and this is also an election student, it is also an election like the small pool. If the election is made, the following steps must be taken. Each short life asset is put into a separate column, same as the private use asset pool. Each asset is privately used, we have a separate private asset pool for each asset, and in case of short life asset also we have a separate column for each short life asset. In the capital allowance computation, on disposal within 8 years of the end of the period of account in which the asset was acquired, a separate balancing allowance or balancing charge is calculated. When we dispose of, balancing allowance or balancing charge is calculated, as it is a separate pool. The election written application to HMRC must be made to enable assets to be treated separately in the capital allowance computation on short life assets. This is known as depooling. That is, the election must be made and written down, and this letter must be submitted. This application must be submitted to HMRC to specify the assets which are under the short life asset pool. The election must be made by the first anniversary of the 31st Jan following the end of the tax year in which the period of account which includes the acquisition ends. That is students, the election that the asset will be under the special rate pool, the election must be made by the first anniversary of 31st January following the end of the tax year in which the period of account. This is claiming when we can claim the exemption. Within a specified time limit, we need to claim the exemption, students. We need to claim this exemption. That is, by first anniversary of 31st January following the end of the tax year in which the period of account. So end of the tax year following first anniversary, which includes the acquisition ends. If no disposal has taken place within 8 years of the end of the chargeable period in which the acquisition took place, the unrelieved balance is transferred to the main pool. So if we have treated the asset as a short life asset pool and we are not able to sell the asset within 8 years, then the unrelieved balance is transferred to the main pool. The transfer takes place in the first chargeable period following the 8th year anniversary. After 8 years, it will be transferred. Note that the AIA is available against short life assets and the business can choose the expenditure against which the AIA is matched. However, if eligible for the AIA, there will be no expenditure left to depool and the short life asset election will not be made. If we wholly claim the AIA students, then we can't use the short life asset. So the short life asset is given the third priority. If there is expenditure in excess of maximum 1 million of the expenditure eligible for the AIA, it may be advantageous for the AIA to be allocated against the main pool expenditure rather than a short life asset and for the short life asset elections to be made. So I hope this is clear. The AIA allocation must be done to special rate pool first, main pool, then coming to the short life asset pool, then to the private asset pool. So students, this is a pool, includes the expenditure of plant and machinery which would normally go in the main pool where it is in the intention to sell or scrap within the 8 years of the end of the period of account. I hope this is clear. This point is clear. And students, the assets which are in the main pool will only be selected. And this short life asset is an option, students. It is not mandatory. And students, if after 8 years we are not able to sell it, then the unrelieved balance will be transferred to the main pool. And the AIA and students, the AIA will be allocated first to the special rate pool, main pool and short life asset pool, then the private asset pool. I hope this is clear. Now we will be solving a question. Short life asset pool. G has traded for many years, preparing accounts to 31st December each year. The written down value on the main pool was 15,000 on 1st January 2003. In May 2003, she acquired a new machine costing 10,000. She anticipated that the machine would last 2 years, so it is less than 8 years, and she eventually sold it on 30 June 2025 for 1,750. In August 2023, she acquired plant and machinery for 1,002,000 pounds. Calculate the capital allowance for available for 3 years to 31st December 2025, illustrating whether or not an election to treat the new machine as a short life asset would be beneficial. So students, when we claim this is an option. If students, if we are sure that we will create a balancing allowance on any asset, we will elect this. So the as short life asset pool is a choice. It is not mandatory. It is choice, not mandatory. I hope this is clear. It is advantageous to make this election, students, if it is anticipated that balancing allowance will arise within 8 years following the chargeable period of acquisition. So students, when we will choose the short life asset pool, if we have balancing allowances will be created within 8 years following the chargeable period of acquisition. That is, that within, because till 8 years we can calculate, and after that it will go to the main pool. But if we are sure that before 8 years only we'll have a balancing allowance means the proceeds, disposal proceeds will be low when compared to the value, so that we can claim the whole amount as allowances. So there will be no further adjustments. Balancing allowance, please remember students, the balancing allowance will be available when the disposal proceeds is low when compared to the value before the disposal proceeds, such that we have a positive value here. This we can claim balancing allowance. I hope this is clear. As it is for each asset, so we can identify the balancing allowance easily. Now we will be solving a question. This question, students, we need to calculate for 3 years, 23, 24, 25. So year end December 23. So as we have already seen here, students, first illustrating whether or not election to treat the new machine. So first we need to see without election and then with election, because it is a option. So first we will be calculating without making the election. So students, so year end of this, let me 1 minute, students, the network is too slow. So without election, year end December 23. So no election means only we'll have main pool, FIA, AIA, main pool, and no other pool. Machine only has been purchased. So directly we'll write the allowance column, students. No need of writing all the columns, as we have already done many questions with the format. So now tax written down value brought forward. So it was on 1st Jan 2023, it was 15,000. So additions qualifying for FIA and AIA. So plant and machinery acquired on 1st May 2003. So 10,000 machine, 10,000 pounds. AIA will be available, students. So we are not making here the election. So we are calculating the AIA under the main pool. So AIA of 10,000 will be available. Then on 1st August 2000, she acquired plant and machinery for 1 million. So plant and machinery. So AIA will be available of. So the AIA will be available only for students. The total AIA will be 1 minute. The total, because this is only of the limit of 1 million. So the rest balance will go to the main pool, that is 12,000. This is clear, students. So 12,000 main pool. Now Any additions not qualifying? Nothing. Any disposal? No disposals. As we have a disposal, but do we have any disposals? No. Acquired, anticipated machine lots? No, students. So excuse me, now we'll be calculating WDA at 18 percentage. It will be, students, 4,860. So the tax written down value carry forward will be 22,140. So 4860. So the total allowance, students, will be 1,004,860. Now same format for the year ended December 24. No additions. So WDA will be at 18 percentage directly. Will bring forward this and it will be the same. So it will be 22,000 brought forward 22,140 into 18 percentage. This will be 3,985. So for this year the allowance is this much. So the tax written down value will be, students, 18,155. Now for the year ended 25, TWD brought forward will be 18,155, students, and we have made the disposal in the year 25, that is 1,750. So which is low. So disposal proceeds 1,750. So this will give rise to the balancing allowances. No, students, it will not give rise to balancing allowance because we have not made the short life asset pool exemption. No short life asset is available here. So the remaining value on which WDA will be calculated is 16,405. So it will WDA at 18 percentage will be 2,953. This will give rise to TWDV brought carry forward, that will be, students, 13,542, and this is the allowance for 25, 24 and 23. Now students, we have seen in our calculation that if we had claimed short life asset pool exemption, then balancing allowance would have arisen. Now we'll do as per the election of short life asset pool. So FIA, AIA, main pool, short life asset pool, and directly the allowance columns. So the tax written down value brought forward will be, students, in the main pool 15,000. Year ended December 23. So any additions qualifying, we have additions, students, which qualify for FIA or AIA. So for AIA we have plant and machinery, students, that is, first we need to allocate the AIA to special pool, main pool, then short life asset pool, and here the asset which we have purchased, the plant and machinery which have less than 8 years, 2 years only is accepted to use. So we'll calculate under the, we are making the election short life asset pool. So the AIA will be only available on this pool, that is 1 million pounds. So it will be 1 million. But AIA is not available, students. So and further plant and machinery, 10,000 costing, which we are special pool, not special pool, short life asset pool. Now students, any disposal? No disposal, so we will be calculating WDA at 18 percentage, that is 15,000, 10,000. As this is the main pool item, the short life asset is calculated on the plant and machinery, which would normally be in the main pool. So the WDA will also be at 18 percentage, students. It will be, and the 2,000 we forgot here to add, so it will be 17,000. So 17,000, 18% will 3,060, and here it will be 1,800. So the total will be allowance we can claim, students, 4,860. The tax written down value carry forward will be 8,200 and 13,940, and the allowance will be 1004860. Now coming to the year end of December 24. So December 24 TWDV brought forward will be, students, 13940, 8,200. So WDV at, as we have no additions or disposal in this year, so it will be at 2,509, and this will be 1,476. So the tax written down carry forward will be, students, 11,431 and 6,724, and the allowance we can claim, the total of this plus this will be total of 3,985. So the total allowance for 24 is 3,985. Now year ended December 25. So TWDV brought forward will be, students, 11,431 and 6,724. So students, additions, no addition, we have a disposal, lower of DP and cost. So the sale proceeds is lower, which belongs to here, it will be 170. So this will give rise to 4974. So this will be an balancing allowance. Balancing, because the short life asset pool is a separate pool for each of the asset. Same case, private pool and short life asset, for each asset you have a separate pool. So when we have a positive figure, it will be balancing allowance. So the whole amount we can claim the allowance. Now coming to this, the WDA will be calculated. WDA at 18 percentage, students. So the WDA will be 2,058. So the written down value carry forward will be 0 here, and here it will be, students, 9373, and the allowance is, total allowance is 7,032. So students, now which is which will be benefit to us? The benefit will be calculating or doing the election. The election will be benefit, because we can claim 7,032 capital allowance, but excuse me, but if we had not made the election, we were only able to claim the allowance of 2,953. So as we have seen that the short life asset pool is an choice we can make, it is not mandatory. So it will be advantageous when we have a balancing allowance, within 8 years, of the purchase of the asset, within 8 years of the purchase of the asset, students. I hope this is clear. And student, the 8-year period will start from which? The intention to sell the item within 8 years of the end of the chargeable period of acquisition. Chargeable period of acquisition means accounting period, not tax year. It is accounting period. Do not always confuse with the tax year. Everything is based on accounting period. So we have a Jan to December accounting period and we have purchased in November. So from this is 23. So from 1st Jan 24 to plus 8 years, it will be 31st December 32. So from the end of the accounting period in which you are purchased, this year you will be able to calculate the WDA, but no issues. But it must be this period, that is 8-year period, means starting from the end of the period of account in which the asset was purchased. I hope this is clear. Always it is accounting period, not the tax years. Now students, we will be seeing some small topic, VAT. What does VAT means? VAT means value added tax. We will be covering this value added tax in our last chapter, and this is an indirect tax. But now we'll be studying the interrelation of value added tax with the cost of the asset which we have purchased, that is the qualifying expenditure. In some examination questions, you may be given the figures for additions and disposal including value added tax. VAT is charged by business on most sales, and hence when another business buys the item, its cost will include VAT. So it will be charged on most of the sales, and hence when another business buys the item, its cost will include VAT. If a business is registered for VAT, it can reclaim any VAT it has been charged on the purchase of the tangible non-current asset. The only exception is car, for which VAT can only be recovered if the car is 100% for business use, such as driving school or car purchased for resale. So students, if we purchase any asset and if we pay the VAT, if we have VAT registered, we can reclaim the VAT. So now students, when we are calculating our capital allowances, we use the original cost. When we purchase, the VAT will be included. So here the point says that if you are VAT registered, you will be able to reclaim it. So do not include the VAT value. And the VAT is not recoverable on cars which are used for private purpose. If the car is used 100% for business use, then we can claim the VAT. If the business can reclaim the VAT, then the cost of asset in capital allowance computation must be net of VAT. Net of VAT means students, VAT should not be included. So students, let's take an example. The same will be following. The net will be 100% and the VAT will be 20%. Example. So the gross will be students 120. So how will we calculate the net? 120 into 120 divided by 6 into 1 by 6. That is I hope this is clear. Every time you need to do 1 by 6 so that you arrive to your amount. That is now 120 divided by 6. This is the VAT. So the net amount will be 100. I hope this is clear. So net will be 100%. Net of VAT means it will not include the VAT amount, students. Gross means, if gross amount means it will include VAT. It will include VAT. So students, so net plus the VAT amount will be gross amount. And if we are registered and we are able to claim, the cost of the asset will be net of VAT. When the assets are sold, the business, If we are not VAT registered, we will calculate on the gross amount. When the assets are sold, the business must charge VAT on the sale proceeds of any asset on which VAT was reclaimed on the purchase. Since the business must pay over any VAT it collects to the HMRC, the actual proceeds kept by the business are the proceeds excluding VAT. If business has charged VAT on the sale, the proceed figures in capital allowance computation must be net of VAT. VAT is charged at 20%. So the VAT percentage is student 20%. If we are registered for VAT and we are able to claim it, we should only the cost of the asset we need to use is net of VAT. Net of VAT means only the original cost. We should not include the VAT amount. Gross is net plus VAT. This you need to have an understanding. If we are registered, we can claim. So we can use the cost of the asset in the capital allowance, that is net. And if a business can claim it and when we are selling it, then the sale proceeds in the computation should be net. If we are not registered, we'll use the gross amount. Registered net amount will be 100, that is 100%. Gross amount, mostly they'll give you gross amount, you need to calculate the net amount. So gross amount is 120% and the net amount will be 100%. So cross multiplication will give you answer, or either you divide by 1/6 the amount into the amount you'll get minus this amount will be the VAT amount. This you need to reduce from the gross amount to arrive to our net amount. But VAT is only available to all assets, but exception for car. The car must be wholly used for 100% for the business purpose. Now let's see a small example, students. Kiran has a business manufacturing computers. She is registered for VAT. So she is registered for VAT, she can reclaim it. In the year ended 31st March 2024, she brought machinery costing 27,000 pounds and a car for herself costing 12,790. She will use the car 60% for business. She also sold an old piece of machinery for 1,200. All these figure includes VAT at 20%. So this is including 20% students. So 27,000 is including gross. So we need to find the net amount. Either 100 divided by 120 will be 27,000 into 100 divided by 120. 27,000 into 100 divided by 120 will be 22,500. This will be the cost we need to use in a capital allowance because we can claim it. Car, VAT is not recoverable because there is private use. So we can't take the net amount. We need to take the gross amount. Disposal proceeds, students, 1,200. So divided by 6, this will give you 200 minus the gross. This will give you the net amount. So net amount will be 1,000 or 1,200 into 100 divided by 120. This will be 1,000. So the sale proceed needs to be 1,000. So student, the basic here idea is, the basic background is that VAT registered, use net amount. Not registered, use gross amount. And VAT can only be claimed on car if it is 100% for business use. Private use, use gross amount. I hope this is clear. Now we will be moving to the last topic of this chapter, structure and building allowances. This is a separate allowance which is available for qualifying expenditures. Now we will be studying what are the qualifying expenditures. Where a business incurs expenditure on qualifying costs for new non-residential structures. So structures and building allowance are not provided on non-residential, only provided on commercial structures, only on commercial. Non-residential, it will not be provided. Where a business incurs expenditure on qualifying costs for non-residential structures and buildings or renovation or extension to existing building on or after 29th October 2018, they will be eligible for SAB. So the qualifying expenditure, the qualifying cost must be on non-residential structures and building or renovation or extension to existing building on or after 29th October. So on 29th October 2018 or after, whatever the expenditure which we have done on the non-residential structure and building or renovation or extension will qualify for structure and building allowances. In the examination, question will only be set where the building was constructed or renovated on or after 6th April 2020, 1st April 2020 for limited companies. So in question, it will be always stated the expenditure has been done on or after 6th April, and where relevant the construction date will be given. Where buildings are purchased as opposed to newly constructed, it should be assumed that structure and building allowance are not available unless stated otherwise. So students, if we purchase a new building, it will not qualify for structure and building allowances. But if it is stated, we will calculate it. Relief is given on an annual straight line allowance of 3%. So this is straight line basis of 3%. For each year it is per annum, it is 3%. And here students, the date of purchase is important. The date of purchase is important here. The allowance can be claimed from the date the asset is brought into use in the trade. It will therefore be time apportioned in the first period. SBA are also available to property letting business, that is we have covered in chapter number 4 FHL. I hope this is clear. The structure and building allowance is available on qualifying expenditure students, and the qualifying expenditures are expenditures on the construction of the building or structure itself or acquisition. We can acquire also, but if it is stated that we need to calculate the structure and building, then only we'll calculate it. And the structure and building allowance is provided at a flat rate of 3%. And here students, the date of purchase is important. Under the structure and building allowance, the date of purchase is important. We will time apportion it. If we purchase or renovate the building for 3 months, before 3 months only, then only 3 months structure and building allowance will be available. But for the previous item, we have seen for all the capital allowance, the purchase date was irrelevant. But under structure and building allowance, the date of purchase is important. I hope this is clear. And the allowance is calculated 3%. Expenditure qualifying for structure and building allowance. Buildings including office, retail, wholesale premises, factories, warehouses, and the cost of subsequent improvements. Structures including roads, walls, bridges, and tunnels. Qualifying costs do not include land, legal fees, or repairs and maintenance. So students, the qualifying expenditure is on building, including offices, retail, wholesale premises, retail and wholesale premises, offices, factories, warehouse, and the cost for subsequent improvements, that is capital expenditure in nature. And structure includes road, tunnels, bridge, walls, etc. And students, the qualifying cost will not include land cost, legal fees, or repair and maintenance. So the land cost, planning fees, legal fees, repair and maintenance, and tax, stamp tax, legal fees, planning fees are all not included. So the qualifying cost will not include legal fees, land, repair and maintenance, stamp tax, planning fees. When an unused building is purchased from a builder or developer, the qualifying cost is the price paid less the value of the land. So students, when an unused building is purchased from a builder, the amount which is qualifying for structure and building allowance will be the amount which we paid less the value of the land, because on land the structure and building allowance will not be available. There is no pooling system for assets eligible for SBA, so they are kept separate from each other assets that qualify for capital allowance. Any asset eligible for SBA will not be eligible for AIA. So if we have seen the structure and building allowances which qualify Under this allowance, we will not be claiming AIA. The AIA will not be available. It will not be eligible. When an asset is sold, any SBA claim will increase the sales proceeds of the asset for chargeable gains purpose. See chapter number 7. So students, when we calculate the chargeable gains on the structure and building allowance which have been sold, the structure and building allowance till date which we have claimed will increase the sale proceed value. Will be covering more detail in chapter number 70. There is no balancing adjustment made on the sale. The buyer will take over the remaining balance and if necessary allowance will be apportioned in the period of disposal. So students here, balancing allowances and balancing charge will not be available here. Here you can claim the structure and building allowances for 33, for this much period you can claim, that is 33 years and 1/3, an extra 1/3 year, 33 years plus 1/3 of the year. So for this period we can claim the structure and building allowances. And students, when we sell the asset, when we calculate the chargeable gains, this will increase the sale proceed, the amount on which the amount of structure and building allowance already claimed. And let's take an example. I have incurred 10,000 on the structure and building. So for 3 years I own it and I claim 3%. So 3% for 3 years it will be, students, 900. I hope this is clear. Now, as we have calculated for 3 years, now when I transfer or when I sell to the buyer will calculate the allowance, the buyer will take over the remaining allowance and if necessary allowance will be apportioned in the period of disposal. So students, this 900 already we have claimed for 3 years. The buyer will only claim for 30 years and 1/3 year. 30 years plus 1/3 year, that is 1/3 of the next year. So on structure, the structure and building allowance is available for 33 1/3 year. For this much year only the structure and building allowance will be applicable, students. I hope this is clear. And each time we do subsequent re-improvement, for that subsequent re-improvement or the improvements for the capital expenditure, the same 33-1/3 year rule will apply. For this much year you can calculate, you can claim the structure and building allowance, and when we transfer it, when we sell to the buyer, and when we sell to the buyer, students, the buyer will calculate the structure and building allowances from that period. So no balancing charge or balancing allowance will be created. Whatever is the remaining amount, students, that is 900, it will be 9,100. On this amount he will claim 900 we have already claimed and we have purchased it on 10,000, students, and whatever the buyer from that period, when we sell it, the buyer will be calculating the capital on the structure and building allowances for the rest of the period, that is 33 and 33 1/3 year less the years which the person has already claimed. So for 30 1/3 year we can calculate the structure and building allowances. The buyer can calculate it. I hope this is clear, students. This is clear. Structure and building allowance is calculated on qualifying expenditure, that is building including office, retail, wholesale premises, factory, warehouse, and cost for further improvements. Qualifying cost will not include legal fees, land and repair and maintenance, and the structure and building allowance is calculated for 33 1/3 year. I hope this is clear. And when we sell the structure and building, on the expenditure on which we are calculating the SBA, If we sell, no balancing allowance or balancing charge will be calculated. The buyer will take over the remaining allowances, and if necessary, allowances will be time apportioned in the period of disposal. As already mentioned by me, the time when the asset is available and time when we dispose, the dates are relevant. But in a previous computation, in a previous capital allowance computation, the date was irrelevant. But here the date is relevant. Here the date is relevant, students. Here the date is relevant. I hope this is clear. I hope this is clear. Now we'll be doing a question so that we have a better understanding. During the year ended 31st March 2024, A incurred the following expenditure on new factory constructed to use in his business. Land, 220,000 pounds. Leveling of land, 9,000. Factory building, 350,000. Planning permission, 2,000. The factory was brought into use on 1st September 2023. Calculate SBA for the year ended 31st March. So students, now we need to calculate the for A. So the qualifying expenditure will be, students, land will not be included. So land will not be included. Leveling of land will be included because we are leveling the land for the business use. Factory building will be included, 350. Planning permission will not be included. So the qualifying cost will be, students, 359. Excuse me. So the structure building allowance will be, students, as it is a factory that is newly constructed. So the structure and building allowance will be available at 3% to students, and it is the asset was brought into use factory 1st September, October, November, December, January, February, March, for 7 months only. As the date here it is relevant, students. In a previous computation the date was not relevant, but here the date is relevant. So the structure and building allowance will be 6,283 pounds. I hope this is clear. Now coming to the case number B. Question number B. Explain the structure building implication for A and the buyer if the building is sold for 750 on 1st December 2032. The buyer has a year end on 30th November. So A sold the building on 1st December 2032. So till that we need to claim the structure and building allowances. So for 24 we have claimed it. So from 24 to 25, 25 to 26, 26 to 27, 27 to 28, 20 like that we need to claim. So we'll be calculating it. So now coming to the for A. So students, so the date is 31st March we have already calculated, and on 1st December. So now we need to see what is the implication for the buyer. So students, the buyer has a year end of 30th November. So the buyer purchased on December 32. So year end is 30th November. 30th November, that is 33, because already we have sold it. So explain the SBA implication for A and the buyer. So for both we need to say the implication. So what will be the cost, students? For now A is selling it 359,000 into 3%, and students year end is April, May, June, July, August, September, October, November, and so for 8 months for A, because we have so this will be, students, 1st April 32 to 31st March 33. So we have used this for 8 months. So 8 months structure and building allowance, the A will calculate into 8 divided by 12. This will be, students, 7,180. This A will be calculating. And now for the buyer, students, now for the buyer, the purchase price is irrelevant, students. The purchase price is irrelevant. The purchase price is irrelevant. Already I stated that the buyer will take over the remaining allowance on the same value on the asset which we had calculated it. That is the original cost. So now for the buyer, the purchase price will be irrelevant. And students, the buyer will claim structure and building allowances of 359,000 into 3% into 12 months. The whole he is calculating because, students, he purchased on 1st December 32 until 30th November. So it is for 12 months period, 30th November, 1st December 32 to 30th November 33. So here it will be, students, 10,770. I hope this is clear. And students, we have also seen that why the structure and building allowance is calculated for 33 and 1/3 year, because we are calculating 3% for each year, and if you multiply this, it will be 100%. 3% for 33 years, it will be 99 years, and 3 into 1/3 year will be 1%. So plus 99 plus 1% will be 100% we have claimed. So the logic of the 33 1/3 years is clear. So students, structure and building allowance is available on qualifying expenditures like office, retail, warehouse and wholesale and retail premises, factories and warehouses, and the further capital improvements, capital expenditure. And on the further capital expenditure, you will calculate the structure and building allowance for 33 1/3 year for each, and it is not available on the value of land and legal fees, land and repair and maintenance. And the structure and building allowance is available on or after 29th October 2018 if we purchase any building. If it is stated in an examination question, then only we will calculate the structure and building allowance. If not, we will not calculate. And the structure and building allowance is provided at 3% per annum. So we can calculate the structure and building allowance till 33 1/3 year. I hope this logic is clear now. Then if an asset is sold to the buyer, in that case the implication we have is, the first implication is the selling the proceed, the chargeable. When we are calculating the chargeable gain, the proceed value will increase by the structure and building allowance already claimed, and the buyer will be further calculating the structure and building allowances on the same amount on which the original owner had calculated this, the seller. And the remaining for only now, as we can claim for 33 1/3 year, and if the seller has already calculated for 10 years, then the buyer can only calculate for 23 1/3 year the structure and building allowance. I hope this is clear, students. By completing this topic, we have completed our today's chapter. I hope this session was interesting. If you have any doubts or queries, please do message in the WhatsApp group so that your query gets solved, and you will be able to connect with other students also. So students, I hope today's session was good. Have a good day. Bye bye. Thank you.